Good morning, everyone, and welcome to today's meeting of the Pension Investment Subcommittee. County Council allows filming and photography at its public meetings, so please feel free to take pictures and use social media during the meeting. Please, though, can everyone present turn their phones to silent or vibrate whilst the meeting is taking place. No fire alarm test is scheduled for today, so if the alarm sounds, I will adjourn the meeting. We will leave the room by the side doors and use the external fire exit to the assembly point in the car park. A reminder that public session of the meeting will be live streamed and a recording will be placed on the council's website. The meeting will be adjourned every 2 hours for a short comfort break. Item 1 is apologies for absence and declarations of interest. The Democratic Service Officer, will you advise us of any absences, apologies?
No apologies for absence. I know Councillor Bowden, I think, wanted to speak.
Thank you, Chair. May I just apologise? I'm going to have to leave the meeting early today.
Thank you. Does any member wish to declare any disclosable pecuniary interest or non-statutory disclosable interest? Thank you. Move on to item 2. We're being asked to approve the public minutes of the subcommittee meeting on the 23rd of May 2024 as an accurate record. If there are any objections, can you indicate now, please?
Sorry, I have actually spotted something on there. Obviously, bearing in mind it's public. It's just the recommendation regarding the Cambridge and Counties Bank. It's described as it was resolved unanimously to approve the report recommendations when there was obviously a decision in that, if you recall, as to so it's just a word in the public minutes whether that accurately reflects what was decided. Right.
So that will need to be amended before we can approve those minutes.
Apologies, I
must admit, I thought that I didn't think that's what I'd read when I saw the draft. I haven't looked at the latest version. I assume they were the same as the draft. So can we have a look at that and we'll defer on that item. Right. So let's move then to item 3, which is the minutes action log. Are there any questions or comments on this or any updates?
Thank you, Chair. No, I'll nothing to add to the paper. Hopefully it's reasonably self-explanatory, but happy to take any questions if there is.
Members, any questions or queries on the action log? No, in that case, we will take the action log as noted. Item 4 is petitions and public questions, and none have been received. So we'll move on to item 5, which is stewardship and engagement report. And if I can pass over to Ben Barlow for this, please.
Thank
you, Chair. Public report.
Thank you, Chair. Hopefully now quite a recognised report. Yeah, okay. So I'll split it into the 3 usual areas. So we've got voting, engagement, and then obviously what LAPF are doing across the whole of the LGPS. So voting, so within this quarter, there's been 285 occasions to vote. 3 of those, 3 where there was not a vote made or that they abstained from the vote. 240 votes for and 37 against the management. What the management is putting forward as a vote. And of the 282, so that's a calculation taking out those 3, 1 was governance, 1 was social, and 280, sorry, I've got that wrong. 1 was on environment, 1 was on social, 280 were on governance issues. So really that explains the sort of things that votes are coming up for in management meetings, AGMs and general meetings. 4.7 refers to the investment manager discretion. So there was no instances where the fund manager has overridden access voting policy in the last 3 months. On engagement, there's been 7 confirmed engagements. Again, strong on the governance. So 1 on the environment, none on social, and 6 on governance. Details of those are in the report, so I won't necessarily go into them. But again, we're trying to bring a flavour of these things in through examples, but we do have all the information if there is any further questions. There's lots and lots of information. This report could be at least 12 times longer if we were to put all that in, but we're happy to pull that out if it's needed by anyone. 6.5 has some detail on who the team has recently seen. So as a team, we try and speak to not only fund managers that we are involved with within the portfolio, but also across the market, just to mainly keep up to date for training purposes. But we also engage, and we always make sure we're asking questions on how they treat their ESG policies, what they do on a carbon perspective. And in relation to that information we're getting, we can sort of challenge a little bit as a team. So there's some information that we do there. And then the final bit, the table in 8.3 is examples of engagements that LAP has done. So this is across the LGPS wide. Again, we've pulled out some examples to try and give a flavour of that, but we have a lot more information should anyone require it. But with that, I'm happy to open up to any questions.
Okay, before I open the public area of this to debate, if anyone wants to talk about anything which is in the confidential area, please can you indicate that you will wish to do so, and we will take that in the confidential part of the meeting, please. Members, over to you then. Anything on the public area of this report? Liz.
Right, okay. Right, thank you. I think it's in the public area. It's item 4.6, and it refers to political donations. And I just wondered some detail on that. Who to, you know, what was the country? Is it internal, external? How much? Just some detail, because it seems to be a strange item. Thanks.
That may well be one we need to take away and dig through all of the
Okay.
mountains of data we have got. But if that's okay, I can do that.
Yeah.
Yeah, if you can, if you could circulate that information to members, that would
Of course,
be
yeah,
useful.
thank you.
Mike.
Okay, thanks, Chair. Yes, I'd like to first of all look at the we got the 3 examples of companies that we've had engagement with, and I'll try to well, I will not mention what the companies were, because is it? I don't know if it's down to Access themselves that say we have to refer to these as A, B, and C in the public domain, or you know, if we've got a real reason why we can't say why these companies are, but I will adhere to it in my comments now. Just looking at company C though, I mean, I'd like to say I'm pleased that we've had engagement with this company. I think that's good, that we need to do things like that. They were the wrong way round the first time we got theirs, but hopefully those who've read the papers will know which company I'm talking about. But I do have some comments on that. I feel we perhaps should be doing something much more robust on the behaviour of this company. The engagement is about some very serious violations they've made, which the American health and safety executive equivalent have picked them up on, and they've had massive and recurring fines. There's also real problems with their work relations and their treatment of their staff, and in particular, quite recently, I mean, it's possible we've had engagement with this in another instance that's not been mentioned, but this particular company has also been fined for its attitude to trade union recruitment, and has engaged union busters in the United States. So it says in the thing we've got here that it's from the United States, doesn't it? And they threatened to close an outlet down if they voted to have recognition for a trade union, and they victimised the trade union members of their staff. And I think that is the sort of thing we really should be having some engagement with this sort of company. This company worries me looking at it. I mean, I'm looking at it even to the extent of thinking, well, should we be going further and saying, should we be investing in such a company whose business plan seems to be to take some very hard business models and to replace the sort of mom and pop operations that perhaps were traditional in this sort of sector in the USA with some very hard-faced and profit-driven sort of company. The other thing I'd like to mention now as well is I'd like to see us do much more on this. I think we've done quite a lot on environmental and sustainability things. I'm not sure that the fund and Access do everything they can at the moment in regards of issues like trade union rights, workers' rights generally, civil rights, and things like torture and oppression in various companies. And I would like to see us be active in this area, very proactive, and I think we can do so very much with it while still protecting all the interests of the fund. And it's difficult to work out and perhaps say in advance what we'd like to do. On Tuesday, for instance, Nike had their annual general meeting, and there was a shareholder resolution at that meeting regarding suppliers of Nike in Cambodia, and I think the other company was Thailand, where these suppliers are simply closed down, left their workers in the lurch, owing very large amounts of money to the workers, and not giving stuff like severance pay in accordance with the rules of those countries. And the shareholder resolution was that Nike should take action and ensure that the workers who are there making Nike apparel should get justice. I'd like to see a way forward where we can flag these sort of things up and say, this is the sort of thing we want our fund to do. Because although the resolution to say Nike should give justice to these workers came from individual, quite small shareholders, and the previous government has made it much more difficult for very small shareholders to intervene in UK company meetings like that. But it was backed by the Norwegian Sovereign Wealth Fund, which I suspect is a rather bigger fund than we are. And it would be good to see institutional investors like ourselves being a force of good for good in the world, and certainly not a force for the wrong things being done, which they possibly, some institutional investors have been in the past. Thanks, Chair.
Yeah, thank you. First of all, thanks for spotting the mix-up we had between company B and C, which we've sent round a corrected paper. So thank you for spotting that. I think what I'd also say is, from an access point of view, there is a lot of discussion at the moment around bringing on a voting and engagement provider for the pool, which hopefully should give us a sort of collective voice and direction of travel, which hopefully would maybe make our voice a bit louder, as you suggest needs to happen.
Yes, if I may, I think another important aspect of it is if that is in place. So at the moment, the engagement is undertaken obviously by the investment managers. If once that provider is in place, what they will undertake is engagement on the things that matter to Access. And one of the things I believe one of the priorities I was just looking up is around human rights. So as well as the a couple of aspects that relate to the E of ESG, that is likely to be one of the engagement priorities for Access, that we will then ask for that, make sure that provider is obviously covering. But I mean, there's lots of, what I would say is there's lots of stocks within the pool, as you can appreciate, and so there will be, it will be engagement across a lot of companies. Not every company we will own, but we will get that coverage in our name. The investment managers will continue to engage in addition to that. And we can obviously challenge them out on that. Obviously, particularly one you've raised, we can obviously go back to the investment manager there and get some further details around that. We'll take a note of obviously what you've said, what is minuted today, and discuss that with Longview. Is that okay? Yeah, thank you.
Thank you. Just to add, I think that Access meeting where that was being discussed around this was fairly robust, and let's say not all funds seem to have the same concerns about this level of engagement that we have publicly expressed before, and we continue to be concerned about. And I think this fund is probably an awful lot more concerned about those kinds of things than a lot of the funds are. And I think it is important, that while we're fully respecting our fiduciary duties, we do also think about all of the ESG elements as well. Members, any further questions on the public section? Liz?
Yeah, just an observation. I think it would be useful. I know you said, we could expand the report, but maybe in future it would be useful to have some examples of the types of engagement on, I guess, the types of environmental issues, just so that we can report those back to our, pension members. I think, that would be welcome, to show how, we're managing the funds. Some good examples there. Thanks.
Yeah, no problem. We'll try and pull that out for the next report.
Members, any further points? In which case, we are being asked to note the report. Are we happy to do so? Thank you. Okay, if we move on to item 6, then it's the Cambridgeshire Pension Fund Quarterly Performance Report for the period ending 30th of June 2024. Peter Gent and Jonathan Crowther from Mercer will introduce the report, and this is the public report, I believe. So over to you, gents.
Should I go? Yeah, thank you very much. So from page 25 of the packs, and just given where we're sat in the reporting cycle and the meeting cycle, these numbers are to the end of last quarter, so 30th of June. And as a result of that, I'll kind of keep comments to quite a high level, given things have moved on since then, and I can give more flavour of that in the private session. So my approach is going to be to focus on page 28, which is the executive dashboard, just to give you the highlights. Obviously, more than happy to take any questions. So just in terms of the position of the fund, so generally markets ticked up over that Q2 of the year, supported by inflation coming under control, the rate hiking cycle turning over, and long-term interest rates starting to fall as we go through a new part of the credit cycle. More of a soft landing in the global economy generally. Inflation didn't tip everyone into recession as was expected a couple of years ago. So that's generally been supportive for markets. In terms of the liabilities, so they've fallen marginally. Again, that's very much linked to long-term interest rates that ticked up ever so slightly. So the value of those liabilities came down a little bit. Value of the assets actually increased. Apologies, there's a slight typo there. So they were up around 43 million, not down. What that has left the fund with at the end of June is a funding level of 170%, so a slight tick up. So really strong funding. That will get a restrike as at 31 March next year, and the actuary will discuss assumptions and therefore impact on contributions for employers at that point. So that funding level is helpful in those discussions, but not the key determinant, and there will be a lot of work for the full pensions committee to work through in that. In terms of performance, so the performance of the fund over the quarter versus the market-related benchmark as opposed to the funding benchmark was an underperformance, 0.7% versus 1.9%. We've discussed this at length in the past in terms of some of the difficulties we have in benchmarking those alternative assets, because there isn't a live market that we can go and invest in and readily assess performance against. We get lagged performance coming through on some of those private equity assets. And we've seen some of the market sell off through 2022 and 2023 starting to come through in those numbers that aren't reflected in the benchmark. So that is a factor in there. But we also have seen some underperformance of the active global equity managers. You can see there Dodge & Cox, Longview and J.O. Hambro. There are clearly a number of reasons for that. One of those reasons is that the market benchmark is very concentrated in US technology, whereas those managers are less so, and that's really driven the market. So you would expect some underperformance. But clearly, we as advisors and you as members want to hold those managers to account. And we have had lots of discussions with you over the past year or so on those managers. And there is an assessment day coming up to look at those managers and get into that performance and assess those versus the alternatives within Access, either to make sure they are still fit for purpose or whether there is scope to change them as a result of that underperformance. So that will be an ongoing piece. In terms of the asset allocation, again, quite a key determinant in terms of performance. So within bounds, the equities are slightly overweight. The fixed income is slightly underweight. There has been a lot of work going on to rebalance that alternatives allocation back up to benchmark. So over that period, the investment was made in the Aviva Lime Property Fund, which is giving us long-term inflation-linked cash flows, which is good from a risk point of view, but also helping rebalance that position. A lot of work has been going on to rebalance the infrastructure assets and looking to do that at attractive pricing. There are market dynamics where there are a lot of sellers or forced sellers for structural reasons in that market. So the fund has been an opportunistic buyer there to top up allocations and come back to benchmark. So overall, a fairly quiet quarter in terms of monetary position, but the funding level remains strong. Happy to go in any of the pages on this report or obviously take any questions, but I'll pause there.
Chris.
Thank you very much indeed, Chair. Because this is the public session, I think it's worthwhile just raising one particular issue and getting some clarity from our advisors. It's always better, of course, to have a funding level in a pension fund which is higher than 100% rather than lower than 100%. However, there may be some eyebrows raised by those outside the council and outside the fund about the figure of 171% as a funding level. And to avoid any misinterpretation by those who wish to misinterpret things which come out of Alconbury, may I just ask for some further clarification about that 171% figure? Specifically, number one, it's not so high as to be in some way a sign that we've done anything wrong or that we've failed to get a correct balance in what we're doing. And secondly, that even if it still is at that position when we get to the end of the year and the actuaries start looking at it, any correction which may take place to do with funding from contributions, whether they be employer or employee, any correction will be quite minor in order to bring that figure down. It's not as though we can halve or almost halve our contributions and then say, well, we'll be in a satisfactory position. So I'd just like some clarification for the benefit of the public that 171% figure is A, not unacceptable, and B, doesn't mean that the fund is so overfunded that there's going to be a bonanza for employers come the new figures.
Thanks very much. One of the things, obviously, the funding level's the domain of the scheme actuary in terms of how they'll determine it. Just to give you an idea and overview of where we are, essentially a lot of it's connected to gilt yields. We've seen over the last 2 or 3 years, gilt yields have moved up significantly, and that has brought the value of the liabilities down. At the same time, the value of the assets have performed quite strongly because of the high allocation to equities. And one of the things I observed last night is that the value of the assets almost doubled since 2016. So I think those two factors together are what have driven a much higher funding level. The actuary will definitely, when it comes around to valuation next year, I'm sure we'll have a look and see how much prudence is baked into that and whether further prudence should be baked in, and then we'll adopt strategy depending on where we get to on that side of things. In terms of contributions, one of the main functions for local government is stability of contributions. So you're entirely correct to assume that it doesn't mean an enormous drop in contributions will come. Obviously, there'll be discussions and negotiations between the actuary and also between the employers. But my expectation is that contributions will continue to remain relatively stable. So they may come down marginally, but I wouldn't expect dramatic reductions to take place.
Mark, did you want to come in?
If I may, Chair, because we're at the point where we are actually setting out the range of options that we would like modelled by the actuary. So absolutely correct. We have a funding strategy. If you think of the large employers as being proxy for the whole fund, the current what the FSS allows is plus 2% or plus or minus 2% per year. So if that remains the same, that's kind of the range over an intervaluation period the contributions could go. If you've got massive overfunding in one respect, but let's be clear that number, it perhaps isn't quite what the general public would think it is in terms of the position we're genuinely in. The way we model employer rates quite simply is we model 5,000 economic scenarios, plug in a contribution rate, and then see what the range of possible outcomes that delivers. and also look at the downside risk as well. So an appropriate rate is set for everybody. But I think generally, absolutely, we should expect to see the stabilisation models continue and work generally within those parameters, although there clearly is some downward pressure for certain employers.
I fully understand and accept the comments which have been made. I just suggest, Chair, that it may be appropriate for us to consider having some strategy to explain this better to the public and to people who see these public figures, so that we don't have any misinterpretations put out by those who wish to misinterpret what the financial position is of the fund.
I think it would certainly be useful for people to understand exactly what that funding ratio is, which is an uncertain estimate of uncertain future payments discounted at an uncertain discount rate, to give us a potential possible net present value of possible future liabilities divided by a figure which may or may not be realizable if we were to liquidate the assets. So it is very much an artificial figure, and I think from my perspective, I think that it's over highlighted in reports to see it there, and it would be much better if it was a less highlighted report ratio, because it is actually such an uncertainty. While it is important, I think it's more important to us here than it is to other people. I think it would be really handy if we could bring it into that kind of context.
I think one of the things as well is that's happened, which is a positive outcome in many ways, is that if we pedal back 5 to 10 years in time, most funds are running deficits. And so there's a lot of concern about how do we do that. We had some fairly dramatic events a couple of years ago, and then very strong equity markets since then, which have propelled the fund into a very good position. I agree with your comments around this is a volatile number that moves around a lot, and really perhaps we shouldn't take too much into account going forward. I think some of the work that we're going to talk to officers about as we start to come into the valuation cycle is about how we think about the assets that we have and the liabilities that sit below the scheme, and how those assets actually might be apportioned to them, to give us a better understanding of actually how much prudence we've got in there, where are we taking that prudence, and then where genuinely do we have some elements of the assets that are less constrained. So I think that will be a piece that comes over the next year or so.
I think I'm tending to agree there. There are obviously, this is all dependent on the discount rate that we're actually using, and the discount rate we're using is linked to long-term gilt returns. We know that long-term gilt returns are currently being affected tremendously by market rate, or by world global events that are going on, and hopefully, the wars that we're seeing around are going to be temporary situations rather than permanent situations, and we may find that reverts back. I understand that there are alternate ways of actually valuing, that are appropriate to think about in terms of this, and perhaps it would be appropriate that we look at those alternate ways of actually valuing these liabilities, and whether it would be better to look at a series of different indicators rather than a single indicator, which may actually give us more stability in terms of what we're then looking at, which aren't actually related to what started off, let's be really honest, following a major trigger within the markets following a budget within this country, which caused massive changes in the gilt rates very, very suddenly. So it may be appropriate to look at something more stable. Chris, did you want to come in?
Thank you, Chair. Yes, I think it's really important that the assumptions which underlie this figure are challenged with the actuaries. I'll be grateful if officers do that rather than leaving it to members. But I think that it really is important, because those assumptions made by the actuary have a substantial effect on this particular number. And it's the impression I get, and I'm not in the pensions business, so I can't say this with any great degree of authority. But from what I've seen, our figure of 171% is substantially higher than the vast majority of other pension funds around the country. And so I think that challenge that you mentioned is really useful indeed. And I just want to make sure that we don't end up in a position where we have to defend something which is difficult to defend without having had it really laid out clearly in public in a future paper.
I think that would be really helpful to bring that together along with considerations of other ways that we can actually consider this so that we can give that certainty.
Yeah, and I think there's a debate going on at this point in time in that I think different actuarial firms have different approaches to the valuation, and you can see quite substantial differences by moving from one actuarial firm to another. And that's not that the numbers of nothing's changed. It's just people's view on how the world is going to play out in the future has changed. So it's right to not draw too much attention to the 170. I think it's more about contributions from a funding projections is how does that impact on contributions? We want that stability in them. But your point is well made. Both of your points are well made around this, and I'm sure we'll come back to it in the next few quarters ahead.
Thank you for that. Members, are there any other points around the public section of this report? I see nothing else there, so we're being asked to note the report. We're happy to do so. Thank you. Right, the remaining agenda items are exempt from publication, so the subcommittee will need to decide whether to exclude the public and press from the remainder of the meeting while these are discussed. The exclusion would be on the grounds that the reports contain exempt information under paragraph 3 of part 1 of Schedule 12A of the Local Government Act 1972 as amended, and that it would not be in the public interest for this information to be disclosed. That is information relating to the financial or business affairs of any particular person, including the authority holding that information. Is there consensus among subcommittee members in support of the recommendation to exclude the press and public? Thank you. As the committee has resolved to move into private session, we will now close the public session of the meeting. I'd like to thank members of the public and press who may have been watching. The live stream will end shortly. Can I just add that I would like officers and our advisors to look very, very carefully at what we are keeping away from the public, because it does feel like an awful lot of this agenda sits in private session, and it does feel like we should be trying to do as much in public as we possibly can. And there was obviously the point earlier, why are we withholding the names of companies that we are very concerned about? Right.